Welcome to Macro Crazy, you greedy pigs. We're looking for profits. I got three things I want to highlight today. Comments from Jeff Bezos, what's going on in the Treasury market, and is that breaking down? And what stocks are going to be impacted from what's happening in the Treasury market. Okay, so for a bit of comedy relief, we're going to start with Jeff Bezos. This guy, he's one of the richest men in the world, even after his divorce. He's like $116 billion rich, so definitely FU money. He's advising that people like us don't be buying big ticket items like cars or refrigerators or anything, it sounds like. So that seems a little strange coming from somebody who's worth that much money. I mean, I laughed. I was thinking about what is he doing in the grocery store, comparing, with coupons or comparing prices on how much, milk has gone up. I had no idea. Honestly, I know. I mean, I'm sure you know too. But like for me, Powerade went from 80 cents to $1.08 a bottle. That hurts. The question though is Jeff Bezos the right guy to be advising us on how we can manage our, measly finances? I don't know. It made me laugh. That's tonight's comedy relief. Hope you found it entertaining. Okay, moving on. We're going to get a little technical here, talk about the treasury market. Bear with me. I'll try to make it as interesting as possible. Okay, there's an article in Zero Hedge. They're talking about basically the Fed and what they've been doing this year with quantitative tightening, which is basically a balance sheet reduction. The treasury market's been seeing a lot of volatility and reduced liquidity. If you're not aware, since 2008, since that crisis, $8 trillion, the Fed has basically $8 trillion of money they put into the market by buying U.S. Treasuries and mortgage-backed securities. This is basically, monetizing that debt, i.e., it's money printing. They've kept yields artificially low since the crisis, since this year, essentially. And if you can combine supply chain problems that we had during the pandemic with this excess money in the economy, that's how you get inflation. So without the Fed support, Uncle Sam essentially couldn't afford our $31 trillion of debt that we're currently carrying. So earlier this year, the Fed agreed to start doing quantitative tightening, which is basically uh, taking out that excess liquidity, i.e., excess money. They were targeting $95 billion a month. But the deal is that would take more than 7 years to clean up all the quantitative easing they did since 2008. And additionally, they've only hit their $95 billion per month target once. That was in August. So they're not off to a good start. And even that very limited kind of program has resulted, as mentioned, in increased volatility and much liquidity. That chart that you're looking at is basically a measure of liquidity. And if you combine that with the fact that the spread between on the run treasury issues, which are the newer issues, versus off the run is at the highest level since 2015. Sorry about that. So, what does this mean? Well, UBS, one of the big investment banks, thinks that the Fed will go back to quantitative easing, in the summer of 2023. And that obviously, you can't do both. You can't fight inflation and have quantitative easing. You got to pick one or the other. If they continue with quantitative tightening, they're going to break the treasury market, it looks like. If they go back to quantitative easing, then they're accepting higher levels of inflation, and that will have downstream effects on all assets. Okay, so now we've established what's going on in the treasury market. Let's take a look at maybe how we can make money off it in stocks. Okay, let's say UBS is right, and come next summer, the Fed flips from quantitative tightening to quantitative easing. That means they'll be buying bonds again, all kinds of treasuries. So yields will be going down. That's a risk-on position for stocks, which means, like for example, companies, technology sector would benefit. So the big technology, Tesla, even Amazon is not really a technology company, but still it's part of the big tech group. It would benefit. As you can see in the image, I list yield-sensitive stocks first. Stuff like utilities. Any company that has a lot of debt, if they can raise money or refinance or whatever, their debt, expensive debt, if they had to issue when rates were high, then that's going to be good for them. So those stocks will benefit. Additionally, economically sensitive stocks, like think of your Walmart, your Target. If I would think that the consumer discretionary stocks would benefit, and consumer staples would be hurt. So I would want to own Target and be short Walmart. Honestly, in fact, you could do a long short trade if you're comfortable with that. Okay, last but not least, obviously the dollar is going to fall, and I've already called for that in previous videos. I think you got to be short the dollar, even more so if yields are going down. So who's going to benefit? Well, exporters. If the revenues are significantly coming from overseas, they're going to sell more if the dollar is cheaper. Conversely, if the dollar is more expensive, as it's been, then it's going to get hurt. So exporters is something I would look at. And if you're overseas or like to trade stocks overseas, companies that sell a lot, foreign companies that sell a lot in the U.S., they're going to be hurt by the weakening dollar. Okay, congratulations. You made it to the end of this video, essentially. I do want to wish you and your family a happy Thanksgiving, safe holidays, and take some time, whether you made money or lost money this year. Take some time to be grateful for whatever you have, and look forward. Let's set ourselves up to have a great 2023.